All right, everybody, welcome back. So this is going to be part 2 of the video that I did the other day on a mechanical trading strategy. I run a lot of these, especially in 2020. In 2019, I was really developing these concepts, these ideas, and I went live in 2020 with a lot of different things. The the main problem is the year isn't done. That's one problem. So I don't have the final year results. And the other problem is I was putting all of the trades in one Excel document. I'm not really good at Excel. And so, you know, if you put things in Excel the right way, it will do things like magic. And if you put them in the wrong way, then it's just a bunch of numbers and you have to go through and try to pick junk out of it. That's what I've been doing. It took a long time just to get SPY dug out of there, and I screwed up along the way, and I would get the wrong data, and then I'd have to go back and redo it. So it was a mess. So, anyways, in this video, why I'm back with another public one. This is going to end up in the next level training library. The idea of the public video was a lot of people don't have the next level training library and don't know if they should get it. This is the kind of material that goes in the next level training library. And so if you've been thinking that, maybe eventually you might want to get the yearly subscription and get access to that stuff, this is what you're missing. All right? And you wouldn't know what you were missing if we didn't do a public video once in a while. So that's what the idea was for the first video. Just kind of let you guys know that I've been working on strategies all year. Not kind of theory, concept. I've been trading them, and I've got some real numbers to show. Some of them, okay, some didn't do that good. This one did decent, and I want you to realize what decent looks like. 78% win rate, 115 winners, 32 losers. I ran it since the first of the year. I'm in 2 right now, so the total trades is 149, not 147. And that's the situation right now. It's up 12.6, I believe, on the year. So not too bad. This isn't one of the better strategies, but it was still an effective strategy. I chose to do this one first, mainly because of its simplicity. All right. Now, in this video, I'm not going to tell you how to do the strategy. I'm not going to give you all the parts and pieces. That's what the next level training library is for. That's where we're going to break it down and talk about what strikes and all of that good stuff. But I do know that there's people who want the library and just maybe can't afford it yet, or thinking that, maybe a little bit later. So let me help you. And there's also people who just want to do things on their own. They don't want someone to point them in a direction with a strategy. That you have enough information with what I'm about to tell you. You could reconstruct this and do the work on your own, figure it out from here. And so let's get you pointed in that direction. December 20 last year, I made a decision that I was going to focus on a strategy that made money. I wasn't really focused on something that won a lot. I wanted something that made some real money, okay, and not something that we had to do a lot of technical analysis and crawl through a lot of fundamental reading and all of that stuff. I wanted it to be a working person's strategy, something you could go in at lunchtime, throw on your trade, and finish your lunch and get back to work. All right. I'm really frustrated with YouTube. If you go and you search for credit spreads or put spreads, bullish put spreads, you're going to run into a lot of videos that talk about going deep in the money. Something like a 10 or a 15, maybe even a 20 delta, 25 delta, and putting on trades $5 wide, $10 wide. And yeah, those are great. You'll win frequently. You'll just be piling it up. It feels really good. You're just nailing it and you're you're all excited about how awesome you are at trading options. And then the market takes a really deep, hard move to the downside, and every single one of your trades comes back to bite you, wipes out all of your profits, and you're sitting in the hole, right back where you started. And the move happens overnight, so you had no chance to salvage the trade, no chance to help out, and you're just crushed. And that's if you was able to even afford the bigger trades. Because I know a lot of people who have an account that's maybe 2,000 or 5,000, and they can't afford to go really wide. And so they're putting on trades at $1 or $2.50, and they're running those, and then they get crushed. Those same people are trying to do things real mechanical and try to increase their win rate by closing the trade early. So then you're in a trade where it's $1 wide and you're out of the money, so maybe you got $25, you're risking $75 to do it, and then you're going to close that down at 25 or 50% profit, right? So then out of that $25, maybe after commissions and everything else, you're getting out at around $10. $10. You had to risk $75 to do it, and in the market extremes that we have right now, when it does move against you, you're beat. You're destroyed. You're crushed. All those wins were for nothing. So I wasn't really interested in winning a lot. Winning frequency, let me say that. I didn't care about putting together a strategy that won 90% of the time. Because unless you've got a really large account, you can't make it wide enough, and you still got the issue with the extreme market conditions that we're in. All right? So I thought, all right, what about for everybody else? So the idea behind this was to focus on that Dow theory. The Dow theory that says the marketplace always goes up. Now, I'm not talking about individual stocks. Obviously, we could point to anything. I mean, even Apple right now is down. I'm not talking about individual stocks. I'm talking about the marketplace overall always goes up. The only time the market does not go up is when there is pressure against the market pushing it down. Okay? And when that negative market pressure fades, the market just buoys back up again. That's what it does. It's what it has done for decades. Are there times where the market goes sideways and goes down? Absolutely. I'm not arguing against that. But Dow theory says the market just goes up. And after running my weekly strategies last year that focused on expected move, we kept hitting the top of that expected move again and again and again. And so I thought, at the beginning of this year, I'm going to put that bullish momentum to work. That we're just going to take a more aggressive stance and just trade very mechanical. And I didn't want it to be too hurtful. So I went $5 wide. Just buying an at-the-money call. Don't make this too complicated, guys. Listen to what I'm telling you. I bought an at-the-money call. The trade was supposed to be done near to 12 days. On SPY, since there's 3 expirations in a week, I had 2 opportunities to do that on Tuesdays and Thursdays. Right around lunchtime, around between 11 and 1, I would go on and buy a call at the money. I'd try to work the order, get a decent price, stay below $5. Now, I made this strategy in December. There was no virus. There was no Rona. There was nothing like that. We had no clue that something like that was coming. All right? Closing before we hit 75% profit, and if it is a loser, then aim for something around a 2/3 loss within or near 3 days to expiration. That's it. Buy a call, hold it near expiration, close the trade. Every Tuesday, every Thursday between 11 and 1. 11 and 1, Tuesdays and Thursdays, buy a call at the money. I can't say this enough. Okay? It's Tuesday, it's 11 in the morning. You go in and you buy a call. Keep it under $5. That's it. Now here's the problem. Everything was going good at first. Back in January, options pricing wasn't extreme. It wasn't volatile like it is right now. You could see the price of those calls, 285, 273, 320, 440. The calls were less than $5 because the extrinsic value was a lot smaller then. We didn't have all this elevated implied volatility. And then we got hit with the virus. And those options, those SPY options that I was buying for $4.40 were suddenly $9. I couldn't afford them. Even now, 9/21/2020, today, we can go in and we look at SPY options. And we don't have 13 days. We'll just look at as close as we can. Tomorrow we'll have 13 days. Look at the call options. $6.11, 733. All right. So I couldn't get them $5 wide. To get a $5 trade, I would have to go out of the money. I didn't want to do that. That wasn't what the strategy said I was going to do. I wasn't going to do that. So I swapped over to putting on put spreads. And I did the put spreads a little aggressive. I was using at the money, it says it right there, at the money puts. Tuesdays and Thursdays at the money puts. And I was running $3 wide at first because, guys, think about what day that is. That's February 18, February 20, 25th, 27th. You remember what the market looked like back then? I do, because these trades were losing and losing and losing and losing. Then it started to finally turn around. Now, there were 4 days in a row where I could not get even remotely good pricing. And I'm not going to tell you what good pricing is in this video. You got to go to the Next Level Training Library to find out what good pricing is. I couldn't even get anything near good pricing. I didn't get it on. All right? So then things started to turn around a little bit. And there are things that you can do with a mechanical strategy to get more or less aggressive, depending on what's going on in the market. You can widen the strikes. You can aim for a greater target on your profit targets. There's a lot of things that you can do. So I started to scale up. I took it into a $5 range instead of a $3 range. I was aiming for 50 and 75% profit. And, even in these, I was still losing every once in a while, but the account just wasn't growing like it had been at the beginning with those calls. And that was the whole point of making this particular strategy. And then the losses started back to back, just getting hammered. And so this little bitty account that really just wasn't growing anywhere because of these calls that I wasn't getting took some serious gut punches. And I said, okay, we're going to have to dial it back again. So we went from $5 back to $3, and we adjusted the target down into the 20s and 30s to increase the win rate. When the wins started coming in good again, I said, time to get aggressive. And I started to buy the calls again, using the credit spread to help me pay for that. It's lowering the cost basis of the calls. That call is $6.51, but I had collected $2.02. So it made that call $4.49. It was something that I could afford to trade. All right. Now, that's when the account started to grow again. I brought in those cost-adjusted calls, and the account just blew up, and that's when the money started coming back in again. And you can see I got hit a couple times. All right. That's what happens with a mechanical strategy with no filter. I didn't think about a filter at the first of the year. I didn't know anything about virus either, right? Hindsight. Sure, it'd be great if we knew that ahead of time. Things were going really good, and then we kind of topped out in the market, and the losses started coming back to back, back to back. Look at the call loss, spread and call loss. That was it for me. Too many gut punches in a row. I got rid of the call, and I dialed back from the 75. If that doesn't fix things, then I'm going to go from $5 to $3, and I'm going to dial back the target profits again, reducing risk in the trade. I don't stop the trade. Just change how big of a trade there is. Just change the risk. Get less aggressive, but keep the trade on. Now, that's my year-to-date profit right now, but these two, I'm pretty sure they're going to be losers. Maybe not this step 17, but that 15, it's a goner. I know it's a goner. There's nothing I can do about it. I'll be closing it out tomorrow. It's just the way it is. So this will be a little bit smaller than it is today, but hey, it's the way it goes. All right. So I've had people ask me, how come I wasn't calling these trades out? That's a fair question. Why didn't I randomly go in every once in a while and post these trades to the Bullish Bears Twitter, or at least come into the chat room? And I want to ask you a question instead. If I came in and said, "Hey guys, I'm going to buy this call on SPY today," and you went and did it, and we lost. And 2 days later, I came in and I said, "Hey guys, I'm going to buy this call in SPY," and it loses. And 2 days later, I come in and I said, "Hey guys, I'm going to buy this call in SPY," and it loses. The next time I come into the room and say, "Hey guys, I'm buying this call," you really think you're going to follow me into that trade? Now, you don't have to tell me the answer, but ask yourself that. Would you really follow me into the trade the next time I came in and said, "Hey guys, I'm going to buy this call"? Or would you say, "Man, that damn Sig loses a lot. I'm not doing anything he does"? And there's your answer. That's why I didn't come in and just say, "Hey guys, I'm buying a call." You wouldn't have known why I was buying it. I would have had a lot of questions too, because some of these calls were literally when the market was going down, I'm buying a call. There would have been a lot of questions like, "What the heck are you buying a call for? The market's going down. It's been down for 4 days and we're still falling." Okay? So, no, I didn't come in and give a shout out that I was getting into an options trade. You wouldn't have had any idea what the heck I was doing. And I would have had to explain all of this just to get to the point to say, "Yeah, maybe I lost the last 3 trades in a row, but this time's a winner." So, no, I didn't post these through the year in Twitter. This is a mechanical strategy that did not have a filter. Okay? I didn't know how good it was going to be or how bad it was going to be, and I certainly didn't want to bring anybody down with me. This is house money. I don't want to lose it, but I do get a little risky with it sometimes. Okay? So, if you want to learn how to do strategies like this, if you want to learn how to make your own strategies, maybe learn how to apply filters, how to make these kind of adjustments when your strategy isn't working, then you really need to sign up for that next level training library. Okay? Because in that library, I didn't make videos about what a call is and what a put is, and I didn't introduce the concept of this is a credit spread and this is a butterfly. You can get that junk for free on YouTube. When I make a video to put into the next level library, I make sure it's something that you can't get for free on YouTube. I put real money on the line. I put the last 9 months on the line, crunching the numbers, putting in the work, taking the losses, taking the lumps to figure out the sweet spot in this strategy. It is right where it belongs in the next level training library. You want access to that kind of stuff, you pony up and join in. You'll have the whole year. You'll learn every strategy in there. You'll learn how to develop your own strategies so that you don't have to rely on something that I built. You can build your own. You'll know how to build your own. Because there's a lot of strategies in there, and there's a lot more coming that are going to be just like this. I've developed 18 different weekly trade strategies. That's right, different strategies, all weeklies, all with an amazing win rate. Monetary win rate, not, "Yay, I'm winning 99% of the time." Ah. So guys, I appreciate your time. This is the mechanical video part 2. And while the new videos for the next level library are not yet in the library, that is where they will be. So this will be the last public video on this topic, or at least on this particular spread. And I will see all of you in the chat room.